Stop making financial decisions based off of your credit score. Start making credit decisions based off of your finances. There's a difference. Batsplaining. And I'm back. You're welcome. Today we're going to be talking about why your credit score is not your grade in life. So, if we just look at the components of how this thing's calculated, there should be some things that pop out to you. This is not an explanation of how to improve your credit. I'll actually be doing that next. But what this is simple observations of why your credit score might not even be a good measure of whether or not you actually will pay your debts back. You may be asking, why am I doing this video at all? Well, the thing is I want you to understand that seeking to improve your credit score when you don't need a loan is likely sacrificing the things that you could be putting your money and your effort towards that will actually help you get further in life. Now, if you're looking at buying a home, getting a car loan or something like that, and you need to improve your credit to get the loan, that's a different story. So what are these observations, these glaring things that make the credit score kind of silly? Well, number one, you have to be indebted to have credit. If you've never had debt, that does make you pretty questionable. But the fact that you have debt doesn't make you credible either. For instance, a recent college graduate who has a staggering amount of student loans, and with this economy, likely still looking for a job, that person has a higher credit score than the person who bought their house and cars with cash. Tell me how that makes sense. Number two, you have to make your monthly payments and do it on time. Well, that kind of makes sense until you think about the fact that on time actually means up to 30 days late and minimum payments. Well, for a standard loan, like a car loan or a mortgage, yes, at the end of the term, if you make the minimum payments every month, you will pay that loan off. That's fantastic. But for credit cards, the minimum payment has nothing to do with paying the loan off. It's the minimum amount the bank will take in order to continue to extend you credit. And they do that because they can still charge you interest. Most minimum payments are somewhere around 1% of the balance of your debt. Well, with rates as high as 30%, if you divide that by 12, your 1% is nowhere near covering the amount of interest that's being charged. Translation, your account's growing even though you're paying for it. Now, the third point. The more accounts you have and the longer you've had them, the better. Well, I mean, if you've been making payments and had a history of having debt, it does seem like you might be more able to pay your debts. Unless you've just been transferring one debt to another to spread that utilization around. It actually is a pretty smart idea, I guess. You pay off the old debt by getting a new debt, and it looks like you've made a good financial decision and paid off that old card and got this new one. But you're really just moving the money around, and you've been paying on the same debt for the last decade. Ugh, what a mess. The way in which you improve your score is not always the way in which you improve your financial health. And so only seek to improve your credit score when you're going to be looking for a loan in the near future. Otherwise, let's invest your time, your effort, and your energy into making financial decisions that are going to put you where you want to be in life. All right, Batman out.
All right, this is where you say thanks for watching.
What? They should be thanking me. I'm out of here. Don't you worry about it, my nerd guy. I got this. Hey, thanks for watching. We hope that you like, subscribe, and check us out over on Patreon. Also, if you enjoyed this video, please share it with your friends. They might just enjoy it too. All right, thanks so much. Bye.